Good morning, everyone, and welcome to the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. Today's topic is financial ratios and using them in your business to assess your overall health. While this is not necessarily the sexiest of topics, it is important for you to understand a handful of the ratios and how, when you figure them out in your own business, kind of overall in an aggregate, how healthy your business is. Each one tells kind of a different story. So you typically want to take a small group of them and kind of aggregate them together to give you a more a fuller picture of what's going on. But not only should you be looking at your ratios if you were, or if you are, for instance, borrowing money from the banks, or you're looking for investors, they are looking at these ratios. They are looking at them and trying to determine, along with other factors, the overall health of your business. So for example, if you're looking to borrow money, the bank is looking to not only determine whether they feel like that you will actually be able to pay them back, but again, the overall health of your business, so that in the long run, you will ultimately be able to pay them back. So there are reasons why you want to look at these. Again, it's not something you do regularly, but it's something when you're doing checkups, especially, I would say at least on a quarterly basis, kind of looking to see where you are, where overall you're falling, not only your own business, but you're a business compared to those in your industry. When we are doing some of these ratios for clients, we typically are running them and looking at their competition, either in their quadrant of the country, or in their revenue range, their area of the country, sometimes the whole country. We want to see how they are kind of falling up against their competition. Are they doing better, worse? Where are there opportunities for making some adjustments and maybe improving things? So again, it's not just you're not just doing the ratios just to run them. You're actually looking to see the health of your business, and then you want to compare it against others to see how you're doing overall in the grand picture. So again, we're just going to be looking to see how efficient you're running your business, how efficiently that you are running your business. And again, it does provide a lot of information when you do calculate them. So you're going to look at them over time. So it does help actually to look at them periodically. So for example, we do look at them quarterly, and we're going to look at them quarterly, and we're going to look to see where we were in the prior quarter and the quarter before that. So again, it helps us to determine some layers of not only your efficiency and your health, but what has historically happened in your business. Is there a really big shift in one particular ratio, quarter over quarter? Why? We want to understand why, what's going on, what's changing in the business. So let's go through a couple of the key ones. There are a slew of them to go through. We're just going to hit on probably 6 or 7 of them. There are many, many more, but these are the ones that I think are the most helpful and can kind of give you a good picture of what's going on in your business versus saying, oh, well, running them for, there are tons of them to choose from. So we're just going to go through 6 or 7 of them that I think will be helpful and that will help you to look at in your business. So first one is going to be it's going to be one. There are 2 of them that we're going to go over that are called the liquidity ratios, right? So the first one is going to be your current ratio. It is simply on a high level is going to be your current assets over your current liabilities. So what are we looking at? We are looking at to see your ability to pay back your short-term debt, right? That's the most important thing. Can you pay back? Do you have the liquidity to, for example, settle your accounts payable? So in construction, your AP is typically going to be your material vendor, your subcontractors that are working for you. How readily able are you to settle those short-term debts? That is really on a high level what you're looking to do. And it really, it's not, well, again, it's not just this one. It's going to be, you're going to want to look at them in the aggregate. Over a period, want to look at them at grouping together. But again, if you can't settle that those short-term liabilities, those liabilities that are less than a year, then you're going to have an overall quote unquote liquidity problem, right? You won't be able to settle your debt. The next one is going to be your quick ratio, and it's going to be your current assets minus your inventory. Now, not all of you guys will have inventory over your current liability. So it's very close to the current ratio. The difference is that we're taking your inventory out of the picture. Again, it's the same idea. Do you have liquidity? Do you have cash to settle the short-term debt in your business? Plain and simple. If you can't settle that 30, 60, 90-day AP that you have a problem. Next, we're going to go over a couple of profitability ratios. We have, I think we've got like 2 or 3 of them. So your first one is going to be your gross profit margin. We talk about margin a lot on here. It is very important in construction because that is going to determine how efficient you are in using the assets that you have, right? It measures the efficiency in your business. Are you utilizing your assets efficiently to generate revenues? So in construction, margin, it's going to vary depending on what type of construction you're in. You know, each one of the kind of various portions or parts of construction are going to have different margin that is preferential for that particular industry, like part of the industry. So it's going to, that's going to be what type of construction you're in. So it's not like, oh, you need to have 35% margin across the board. No, that's not going to be for all aspects of construction. It's going to vary. But again, margin is key. Are you efficiently generating your revenues? So gross margin is simply going to be your revenue less your cost of goods sold. Your cost of goods sold, we've talked about on here before, is going to be your labor, your subcontractors, your material, right? The costs to do your jobs, the costs to create or to run your projects, right? That's your cost of goods sold, and that's going to be over revenue. So it ends up being a percentage, right? So again, the larger the margin is, the more efficiently you're using your money to generate your revenues. The smaller the number is, the less efficient you are at generating your revenues. And it's a big indicator in construction of how well you're doing in your business. Again, if industry states that you should be at 25% margin and you're at 10, then you have challenges in your business. That's just a given. So the other one we're going to go over is now net margin. So net profit margin. That is ultimately going to be after you get through all your cost of goods sold, all your operational expenses, what is the profit and the profit percent at the bottom, right? Once you've gotten through all of your expenses. And it truly is an indication of how you've the efficiency in creating not just your revenues, but, creating the revenues all the way through to the end, right? It's not the same as your gross profit margin. They're two very different things. Your net margin is going to take into consideration your operational costs, whereas your gross margin does not. But if you're operating your projects efficiently, that's great, and your margin number might be high. But if you are not operating your business in the aggregate efficiently, then your net profit margin numbers are going to be low. And again, those are the types of things you want to determine. Are you running not only your projects efficiently, but the entirety of your business efficiently? Another important one is going to be your return on assets. And again, that's going to be your net income over your total assets. And you are looking at that one. And again, it goes hand in hand with the two other profit ratios we just talked about. How efficiently are you using the assets in your business to generate revenues and then ultimately generate profits? So, for instance, in construction, equipment assets tend to be something that most of these businesses have, and you have to utilize your trucks, your heavy equipment, your your bulldozers, etc., efficiently, or you won't be able to generate the revenues that you need to in order to, for example, pay back the debt that you've used in order to purchase those assets. So again, the three of them together, you're looking at the margin, your overall margin on your projects, your overall margin on the entirety of the entity, and then your assets. Are you using those assets efficiently in order to create revenues and ultimately profitability? So profitability is a key, right? We first talked about liquidity. Do you have the cash in order to settle the short-term debts that you have, right? Those, we'll call it the accounts payable, right? Those 30, 60, 90 day. There'll be other things that'll get tossed in there, but for simplicity, let's just say that. Do you have the cash in order to settle those? And then are you utilizing your assets efficiently in the profitability margins in order to get yourself the revenues and then profitability? So next, are going to be we'll go over your it's called a leverage ratio. It's really your debt to equity, and this is a big one, and in construction is a very important one because much of the construction industry is debt funded. You're going to have debt in your businesses because you're going to purchase heavy equipment that's going to be debt funded. Many of our clients have lines of credit. The lines of credit are there in order to give them cash flow in between those periods when you're waiting to get paid from your customers and so on. So your debt to equity ratio is going to be key, especially if you are heavily funded, because the bank is not only looking at the other handful of ratios we discussed, but they're looking at this one as well, right? Can you pay, how much debt do you have? Can you actually pay this debt back? And it's ultimately looking at how much you're relying on debt in order to support your business. So, for example, if you are highly leveraged, if you have a lot of debt, it's more risky for the bank or a potential investor to want to either invest in your business or allow you, say, to borrow more money to purchase another piece of equipment and so on. So that becomes a very important one in construction. It's important in all businesses, but specifically in construction because it is so heavily debt financed. Again, the bank is looking to see how much debt you already have and can you ultimately pay them back. So if they don't feel that you have the ability to pay them back, it makes it very hard for you to borrow more money. And that's as simplistic as it can be, but that's the reality of it. If you've got lots of debt and no ability to pay them back, or you have a lot of debt and it's challenging for you to actually pay back just your short-term liabilities, your AP, then it becomes very hard to borrow more money. One of the efficiency ratios. So again, how efficiently are you turning things over? So your accounts receivable turnover is one that becomes very important, especially in construction. Unfortunately, the terms for getting paid from customers can be very long. Especially if you're working in the commercial area, you could potentially be waiting, 60, 90, 120 days to get paid. So the idea with this is that you want to ensure that you are turning your receivables over as quickly as possible. So basically it's looking at what are your credited sales, so your net credit sales over your average accounts receivable. So what we're looking at is we want to measure how efficient you are at going after your receivables and actually collecting them and turning them over. So again, you want to ensure that you have your receivables that are collected and you're collecting them as quickly as possible. Again, you want to collect them as quickly as possible because you want to convert them to cash because you need that cash in order to settle your short-term liabilities, i.e. your accounts payable, right? And again, very simplistic. There are going to be other things that fall in there, but for our purposes, just let's call it that. So now you start to see how each one of these ratios start to kind of feed into each other. So sometimes when you look at them just by themselves, they don't necessarily tell a story. What you need to do is you need to take a group of them, i.e. the ones that we just referred to, we referenced and we went through. You want to look through those and pull them together to see exactly what the story is that is being told in your business. So, it's really important for you to look at them regularly, quarterly would be great. And then look at them in the aggregate, kind of grouping them together to see exactly what's happening with your ratios. Now, there are issues that you can run into sometimes when you are reviewing them. In most cases, it's all going to be based off of historical data. So it's history. It's not current. So it doesn't necessarily also take into external factors that are going on, let's just say, in the industry. For example, if you are a residential developer, right now, mortgage rates are very high. So it's very expensive for individuals to purchase homes. So that's an external factor that would not necessarily be reflected in your ratio. So again, it's a moment in time. It's going to be history, and it's not going to take into fact things that are going to happen in subsequent periods. So it can be a challenge. You have to be careful how you are utilizing these ratios. The other thing to think about too is it's not always the correct data, or it could be incomplete data and therefore tells you an incorrect story. So you need to be very, very careful. There are also going to be benchmarks in your industry. There are going to be where you want to fall. You want to fall within industry standards. So you want to make sure that you're not just reviewing your own ratios, but you're reviewing them in the picture of what is standard in the industry. Do I fall within industry? Am I outside the scope, either better or worse? If so, why? Why am I doing better? Why am I worse? Et cetera, et cetera. So just to recap, we'll go through the ones that we reviewed today. So we reviewed the current ratio, the quick ratio, which are basic, or two that are pretty close together. There's a small variation between the two, and that's going to determine the liquidity in your business. The next are going to be your profitability ratios. That's going to be your gross profit margin, your net profit margin, and then your return on assets, right? How efficiently are you utilizing your assets in your business to create revenues and therefore create profitability with those revenues? Your leverage ratio, right? That's going to be your debt to equity. How heavily leveraged, how heavily financed are you in your business? That could be a concern for banks or investors. And the last, an efficiency ratio, which basically is your accounts receivable turnover. How efficiently are you turning over those receivables and converting them into cash? Because you need the cash in order to sustain your business. So if you have any questions, please feel free to reach out, drop them in the chat. We'd love to hear from you. As always, we look forward to seeing you here every Friday morning. Have a fabulous day, wonderful weekend, and we'll see you next week.